Hey, if you're looking to create a set of financial projections for a lawn care, fertilization, and weed control business, and really whether you're doing residential or commercial or both, we have a financial projection template here built specifically for this type of business model. So this would be like a True Green or Lawn Pride type of business model. And this template is built specifically to help you with presenting to a potential lender or investor. So if maybe you're looking for an SBA loan to help start your first location, then this template is right for you. I'm going to walk you through the template here. We're going to put a link in the description of the video below to this template so you can grab that and follow along. And as a thank you, if you stick around to the very end of the video, because it helps us, if you watch the whole thing, it helps our algorithm and shows other people that this is a good, if you stick around to the very end, I'm going to give you access to a coupon code that you can use to get a discount on this template as well. So we'd appreciate that. And so I'm going to walk through kind of step by step how you fill this out. Now, there's kind of two different templates I'm going to show you. So one is a single unit model. So if you just want to do this in one city, let's say you're just starting up, you're going to do this in your city, your town. But maybe you have broader ambitions and you want to start a location here, but then you're going to start another location in a nearby city and then kind of start building out from there, and you're going to have multiple locations of this service, home services business. Then this template is going to be able to work for that as well. I'm going to show you kind of two versions of the template, one that I filled out with just a single location and one with multiple locations. I'm going to spend most of my time on the single location because that is what I think you should be utilizing if you're presenting to an SBA lender, for example. Although you can have grander ambitions and building your full empire with 20 different locations someday, a lot of times that might scare away an SBA lender. So why don't you start with your single location first, make that successful, and then so you may have two kind of versions of this, one that you're using for capital raising, one that you're kind of dreaming and planning about what could be in the long term. So just give you a little bit of my background. My name's Adam Huxema. I'm the owner of ProjectionHub. We help businesses create financial projections for potential lenders and investors. I spent a little over 10 years as an SBA lender myself. In my time as the executive director there, I oversaw the approval of 1,500 SBA loans to all sorts of different businesses and industries. So I come to this with that kind of perspective of what is an SBA lender going to be looking at. Okay, with all that out of the way, let's dive into this particular template here. So I am starting here kind of with the end in mind, and this is the at a glance tab. So after you have filled out all of your assumptions, you're going to get this nice profit and loss at a glance, some summary data, some graphs and charts that you can pull into a business plan or a pitch deck. You're also going to get a 5-year income statement summary, 5-year cash flow summary, 5-year balance sheet summary, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. Now, the SBA is going to ask you for the first 2 years to be broken down monthly. We just go ahead and give you the full 5 years all broken down monthly in case you need that. So now, in order to produce these reports, though, we have a little bit of data entry to do here and filling out some assumptions. So first thing you need to know is that any cell that's in blue is an assumption that you can change. So we've got a company name. We're going to call it Green Lawn, and we're starting this. We can set the start date here. We're going to set the starting cash balance as 0 because this is a startup. So we have no cash to start with. We're opening location 1 in month 1 of the model. We have 0 opening accounts receivable because we're not open yet, so we wouldn't have any accounts receivable or accounts payable, so those are both 0. Here for accounts receivable, this average day says sales outstanding. So what does this mean? This means how many days does it take you to collect payment after providing the service. So for this type of business, it's probably the type of thing that you have accounts that are on regular service, and you're going to go do a service call, and then you're probably going to invoice. And then once you invoice, it's going to take a little while to then ultimately get paid. So we set the average at 15 days after providing service is when you'd actually receive payment. Same thing on the accounts payable here. So this is how many days after you receive a bill do you actually pay? When does the cash leave your bank account? Now, if you're paying for things like paying for fuel, paying for some of your expenses on a credit card, you're gonna incur the expense today, but you might not actually pay that credit card off for 30 days or something, right? So you have a little bit of a window there. So that's why you might put in 15 days. You're paying for the fuel today, but it's with a credit card, so it doesn't leave your cash account. All right, so for inventory, we're going to set 0 inventory for the initial balance because you're a startup. And then we're going to say, maybe for the initial inventory for this business, we're going to have $5,000 in initial inventory. And then we're going to keep 100% of the average inventory value. That just means you're going to keep basically 1 month's supply of inventory on hand on the balance sheet. For equity investment, so this is the investment that you're going to make, or maybe other investors are going to make to help get the business started here. For location 1, we're going to invest $50,000 in month 1 of the model. That is going to go towards covering leasehold improvements. So let's say you have an office and maybe kind of a warehouse and it needed some renovations. So you spent $35,000 on renovations there. Life expectancy. This just helps us depreciate these assets. So if you pick 20 years, we're going to depreciate the improvements to the space over a 20-year period. For your equipment, we're going to depreciate that over a 10-year period here. So you can pick the purchase month of those items as well. So we've got location 1 tools and equipment. Let's say we're going to have $25,000 worth of tools and equipment. The lawn care service or the fertilization weed control service I use, sometimes they're out there with what looks like pretty cheap, like just backpack spraying, and those look like that wouldn't cost a whole lot, right? But then sometimes they're out with like machines that are driving on the lawn and doing things really quickly, and those look a lot more expensive. So I think you could probably approach this a couple different ways and probably have a varying degree of what the startup cost there would be for your tools and equipment. And then I just assume $10,000 for computers and software. Okay, and so we're going to have a startup loan here of $75,000. Again, for location 1, we're going to get that loan in month 1 of the model at a 10% interest rate over a 10-year term, 120 months. And then on the revenue input tab here, so we're going to assume that you're going to hire technicians, okay? And so you can add in technicians. So I've got over a period of the 5-year model, we're adding 6 technicians to this location. And it's going to be, we could add multiple at a time if we wanted, but I'm just going to add 1 at a time here. So number of employees is 1 at a time. And I'm going to add the first technician in month 1, then in month 6, I'm going to add another, then month 13, and so on. So when we get to this rate per billable hour of $135, so the idea here is for your technicians, how much are they making on a per hour basis? So you're probably not going to charge your customers on a per hour basis. You're going to charge them on a per service basis, but you're probably doing the math in the back of your head to think through, okay, this service is going to take me about 40 minutes. And so this is what I need to charge in order to be able to get to kind of a goal of a rate per hour. And so really that's probably what you're doing. So you need to consider, how much is travel time going to take? How much is actually providing the service? And all of that kind of goes into one service call in my mind. So if I'm paying somebody if I pay $135 for the service for my yard, I think it's going to take them 20 minutes to get here. They're going to do the work for 40 minutes. And so in an hour, I'm really paying for an hour because I'm paying for the travel time plus the service. And so that's kind of the way I think about this. You're wanting to put how much are you hoping to get from customers on a billable hour basis. So then you're taking the 35 hours a week times 135 to come up with that base revenue per employee per week. This is how many months it's going to take for a new employee or new technician to kind of ramp up to be kind of fully at their capacity of the 35 hours. And then this is the annual rate increase. So we're going to increase that 135 by 5% a year. The rest of this is just calculations on the revenue side. And then on the cost of goods sold side, we have direct labor and we have job materials. So on direct labor, let's say we're going to pay our employee technician $2,600 a month. And then maybe this is taxes and benefits. And we set that to 8%. You could change that to whatever you want. In this equation, I just took the monthly amount multiplied by 8 or 0.08 for 8% to come up with a direct labor cost there. And then for the materials, what I did, I made this little box out here so where you can just set your job materials as a percentage of revenue. So if I set that to 15%, it's gonna go and see, okay, revenue is $135 per billable hour. We're going to assume that 15% of that is material cost for the fertilizer chemicals that we're putting on the yard. And so that will ultimately then calculate here for you if an employee is working 35 billable hours a week at $135 an hour times this 15% material cost, this is what the total cost per employee is for materials in a month. So if you think, yeah, our material cost is actually just going to be 10%. You can set that to 10% here, and this number will adjust. This is white because I don't really want you to change this assumption. I think ideally you would change the assumption over here, and this will automatically calculate. Again, you can set an annual cost increase for these expenses here as well. And then for our other operating expenses, we can set operating expenses, advertising, accounting, credit card processing fees, and so on. You can set these as a corporate fixed amount. So it's just at the corporate level, it's just an expense at a corporate level, a per location. And I'm going to show you how we can do this where we add multiple locations in a minute, or a percentage of revenue. So for advertising, I'm saying we're just going to spend 5% of total revenue on advertising. For accounting, we're going to spend $500 per location that we have. Credit card processing, 3% of revenue. Fuel, sales commissions, and vehicle leasing. So let's look at these. I like to, rather than adding a sales team member as a salaried position, it's easier and just more scalable to say, hey, we're going to spend 7% of our revenue on sales commissions. And so as we grow, we might have more salespeople. Ultimately, that's still going to cost us 7%. That's our goal, 7% of revenue towards sales and marketing or sales commissions. Same thing with vehicle leasing. You could come over here and start adding in vehicles and you say, okay, well, I'm going to add another technician, so I'm going to buy another vehicle. And you could do that where you buy vehicles every time you add a new technician. It's easier and more scalable in my mind to just say, hey, we're going to lease vehicles and it's just going to scale with revenue. So as we add new technicians, revenue is going to go up. So our cost for vehicle leasing is automatically going to go up here as well. All right, so then on our salaries and owner draw, here we're just going to put, since this is just a single location, we're just going to have the owner here, paid $75,000 a year, starting in month 1. And then we're hoping to have a general manager that will hire for $80,000 a year, starting in month 37. So kind of once we get up to a certain level, then we can afford to hire this general manager, take on some of the day-to-day and management. All right, so once we do all that, this is kind of what it looks like. We basically just break even in the first year, move to a nice profit over time, and as we add more technicians and more accounts, you can see what this looks like. Now, I want to show you briefly what a multi-unit would look like. So if we're doing a multi-unit lawn care, lawn fertilization weed control service here, we can see I'm going to add a second location in month 18, and then another 18 months, I'll add a third location, then a fourth location, right? So you'll add in these various new locations. You can add in up to 10. And then you can add in equity investments, but you want to tie it to a specific location. So you can say, okay, I'm going to invest another $50,000 when we open location 2. And this is going to say month 1. But if you look at this note, it says month invested relative to location opening month. So if you say month 1, that's actually going to be month 18. It's going to say, okay, it's going to look at what month did we open location 2? And it's going to apply that investment accordingly. The same deal with these fixed assets here. So the leasehold improvements for the office or warehouse and tools and equipment, all, in month 1 of opening that new location. And then you can add multiple loans, right? So new loans for each location that you open. And this little box down here is helpful for the multi-location. So what you'll see is that this is going to say total cash available, 1.2 million, based on the projections we have in here. By the time we open location 4, we don't need to borrow money, right? So we can delete this, and it's just going to take the cash that we need to open that new location just out of our operating account, out of the business's checking account. So it's not going to need additional loans, additional investment. So you can use this to kind of tell, hey, do I have sufficient cash to open this location? Yes or no? Okay. Everything else is really going to be the same on the multi-location option here, on the input revenue and on these expenses. The only difference I would say is what I did in this example is I said, okay, we're really going big time here. We're going to open a lot of these. Maybe we're going to have our own franchise. So we're going to hire a CEO at the corporate level here, but not until month 25. And then maybe we'll hire a CFO in month 37. And then we'll have the GM that we hire for each new location. But we're going to hire them right away in month 1. So month 1, when we open a new location, automatically we hire GM, and this is going to happen for each new location that we open. And then just keep in mind, so the way this works, this is a per location input. So each location that we have is going to hire their first technician in month 1 of the new location opening. In month 6 of the new location, they'll hire their second, and so on. Okay, so that's how this can scale out, and we can see what that looks like with multiple locations. By year 5, we're at 4.1 million, and almost $1 million in net income. Okay, there's a lot there. I know if you kind of go through this and you're like, I just want someone to fill this out for me, we do offer that service. We offer a template fill out service. We can also customize the model to work for your specific situation. So feel free to reach out to us at support@projectionhub.com if that's something you'd like help with. Just getting it ready to present to an SBA lender, or just having, our experience as SBA lenders to help guide you through that process. So we're here for that if you are interested in that. All right. Thank you for sticking around to the very end. So as promised, you're going to be able to get a discount code. If you go to the description of the video below, there is a link to a form. If you fill out that form, we're going to email you our most up-to-date discount code that you can use on this particular template. And remember that the link to the template is also in the description of the video below, so you'll be able to go grab that and use that here. You're going to get access to both versions, the single unit and multi-unit location template. So I hope that's been helpful. Again, if you have any questions, don't hesitate to reach out. Thanks.